Hi friends, welcome to a brand new segment of FinveStocks, Friday Basics, which will give you good insight about Indian equity market. My sincere effort in this segment is to create awareness to all in simple language. This series will be arranged in such a way so as to understand everyone who are beginners. Please share this video to all those who wish to learn, understand and participate in stock market. Please don't forget to subscribe and click the bell button to get the notifications of upcoming knowledge-packed videos on personal finance and stock market. Welcome back to FinveStocks, where we make everyone understand the basics of money management. Before going into this video, make sure you watch earlier videos of this series, which is mentioned in the I button. In our last video, we saw how to read the financial statement. But understanding the financial statement other than say revenue, profit from financial statement is not an easy task. So the main use of financial ratios is to convert the numbers in financial statement into some useful terms so that anyone can easily understand the company's future. For example, debt in isolation in the financial statement is a number. So you can't judge anything out of that. It will only show whether the company is having some debt or not. But whether that is a safe bet, good debt, bad debt, that nobody knows. To understand that, the ratios will help. For example, in this case, so debt equity ratio is a ratio which will tell whether the company's debt is in a safe zone or in a danger zone. This is the importance of financial ratio. In today's video, we will see what is leverage ratio. What are the different types of leverage ratio and how it is useful in doing fundamental analysis of a stock. Now let's see what is leverage ratio. The term leverage ratio refers to a set of ratios that highlight a business financial leverage in terms of its assets, liabilities and equity. This ratio shows how much of an organization's capital comes from debt. It's a solid indication of whether a business can make good on its financial obligations. A higher financial leverage ratio indicates that a company is using debt to finance its assets and operation. Often, that could be a risky bet for potential investors. So, debt to equity ratio is one of the most important financial tools which gives an idea of how much borrowed capital or debt can be fulfilled in the event of liquidation using shareholders' contributions. So, what is debt to equity ratio? The debt to equity ratio is a ratio between a company's total debt to its total equity. In other words, the debt to equity ratio tells you how much debt a company uses to finance its operations. For instance, if a company has a debt to equity ratio of 2, then it has 2 rupees of debt for every 1 rupee of equity. So how to calculate debt to equity ratio? Debt to equity ratio is total debt upon total equity. Total debt is short-term borrowings plus long-term borrowings, and total equity is share capital plus reserves and surplus. So you can calculate the debt to equity ratio by dividing company's total liabilities by its shareholders' equity. What is a good debt to equity ratio? Generally, a good debt to equity ratio is anything lower than 1. A ratio of 2 or higher is considered as risky. If a debt to equity ratio is negative, it means the company has more liabilities than assets. This company would be considered extremely risky. A negative ratio is generally an indicator of bankruptcy. These guidelines are relatively to a company's industry. For example, in some industries, business may tend to have higher debt to equity ratio, while average debt to equity ratio is lower in some other sectors. For example, if you take finance industry like banks, NBFC, etc., they have higher debt to equity ratio because these companies leverage a lot of debt. On the other hand, if you see service industry, which has lower debt to equity ratio because they have fewer assets to leverage. Now let's see debt to equity ratio through a real-time example. Consider this as a balance sheet of a company XYZ. The company is having a short-term debt of around $48 and a long-term debt of around $80. So the overall debt is around $120. And the company is having total equity of around $175. So debt to equity ratio is 120 divided by 175. that is 0.8. That means the debt to equity ratio of the company is 0.8. So what does the debt to equity ratio tells you? The debt to equity ratio tells you if your company's debt is too high for your business. Higher debt to equity ratio indicates higher risk of closure or bankruptcy. A lower debt to equity ratio indicates lower risk. So as a summary, the debt to equity ratio used for the assessment of financial leverage and soundness of the firm. A lower debt to equity ratio is favorable from investment point of view as it is less risky in times of increasing interest rates. It therefore attracts additional capital for further investment and expansion of the business. The next important leverage ratio is interest coverage ratio. The interest coverage ratio is used to determine how easily a company can pay their interest expenses on outstanding debt. The ratio is calculated by dividing a company's earnings before interest and taxes by the company's interest expense for the same period. So by formula, interest coverage ratio is EBIT for the period upon total interest payable in the given period. Let's see a real-time example. Consider the income statement of a company X. The overall operating profit, that is EBIT for the period, is around 1.783 crores. For the same period, the overall interest expense is around 0.5 crores. So the interest coverage ratio is 1.78 crores divided by 0.5 crores, that is 3.56 crores. So the interest coverage ratio helps us to understand how much company is earning relative to its interest burden, how easily the company can pay its interest payments. Here it suggests the company is generating 3.56 times of every rupee of its interest payments. The next leverage ratio is debt to asset ratio. Debt to asset ratio helps us to understand asset financing pattern of the company. Debt to asset ratio is total debt upon total assets. Let's assume the total debt of a company is 14.1 crores, whereas the total asset is 1374.6 crores. Then the total debt to asset ratio is total debt upon total asset, that is 14.1 upon 1374.6, that is 0.01, which is 1%. What does it mean? It means roughly 1% of the asset held by the company are financed through debt capital and 99% of the fund is financed by owners. The next one is the last financial ratio, that is financial leverage ratio. Financial leverage ratio is an indicator to give indication to what extent the assets are supported by equity. Financial leverage ratio is average total assets upon average total equity. Let's see an example wherein the average total assets is 1272 and average total equity is 826. Then the financial leverage ratio is 1272 upon 826, that is 1.53. Total assets is total equity plus debts. If the financial leverage ratio is 1, which means there is no debt in the company. The financial leverage ratio of 1.53 indicates 1.53 assets for every rupee of equity is supported by equity. So these are the important leverage ratios. So till now we covered all three financial ratios such as profitability ratios, leverage ratio and valuation ratios. In our next video, we will see the last of the financial ratios, that is operating ratios.
Please do like if you like the video and don't forget to subscribe to get the notifications of upcoming videos on personal finance and stock market. Please post your valuable comments. Do follow the Friday Basics to make your stock market journey easy. Thanks for watching and have a good day.